My name is Mark Trice, financial advisor. I'm here in our studio with Jesse Hamilton, another advisor in our firm.
Hey, everybody, welcome.
And today is the May market update for this year, ClearVista Financial Perspectives. And a lot of changes have happened over the month of April, Jesse.
Yes, so last time we were talking about the first quarter of the year, and now we made it another month. We're done with April, and we have a lot of great things to talk about today, especially
Some good, some not so good.
Some not so good. We're going to talk about what the Fed said yesterday, and let's get started.
I'm going to go ahead and turn off the camera, folks, so that you can see our slides. Some of them are a little bit detailed, so I want to make sure we give you lots of room. And let's
Here's our
jump
agenda
around
for today.
Yeah, go ahead.
It's the normal agenda. We're going to talk about April performance from month to month, month over month, and then we're going to talk about the macro environment of the economy. And we will, of course, make our comments about that and the current state of the economy. We will talk about the Fed and interest rates. We'll talk about how this might impact you. And as a reminder, we'd love to interact with you live, or if you're watching this later, we will respond. To email is info@clearvistafinancial.com, or you can send us a text, 254-282-0495. That text line is active, and we would love to hear from you.
I'm looking at it right now.
Yes.
And so if you've got a question, we will answer it live on the program today. And because I'm sure some of you had. Now, the month of April really was a kind of a volatile month.
It was very volatile. We saw a pullback in most of the indexes. So here's the first index that we always cover, the S&P 500. To anyone who's new to these webinars, this is called a candle chart. Each little candle or box is a trading day. Red candles are down days and green candles are up days. So the S&P 500 fell 4.17% during the month of April, generally a negative trend with about a week of positive action towards the end. And of course, notice that last big bearish day.
It was a big letdown on the last day of the month.
Big letdown. And that swing actually, Mark, from peak to trough was 5.91%, which is getting towards correction territory.
Yeah, it is. We consider 10% correction territory. Now, one thing I want to kind of point out, Jesse, and we'll look at the other indexes in just a second, is that one thing that you've heard in past webinars is that we have turned a corner in February. We no longer were in a bear market for the S&P 500. We entered a bull market phase. And when you're in a bull market phase, it is very common to have 2, if not 3, pullbacks in the market throughout the year of 5%, or even maybe 1 or 2 of 10%.
Right. And so this is normal.
Right. It's not what we wanted to see, because we were all excited about the first quarter and things turning around. There was a number of different economic points that came out in the month of April that got investors a little cautious. We'll go into that in just a minute. But this is pretty typical.
It is, and I don't think anybody's especially confident with the markets right now, but if you're fully invested with your savings and you see a 4% swing, it's got to raise a little bit of alarm.
Of course, normal.
So here's the NASDAQ, which is the NASDAQ 100, the tech-heavy index, heavily influenced by these large companies. There's no financial companies in this. And this index closed minus 4.37% in April. It was more volatile than the S&P, which is normal. We see that pretty often. A 7.69% swing there from the peak to the trough. And
now this, at one point, the NASDAQ gave back almost all its gains of the first quarter,
yes,
a year to date. So we were a little concerned about that, but that has settled down just a little bit in the last few days.
This was the sweetheart of all of last year, right?
Oh, yeah.
And we're starting to see that it's not quite performing as well as the overall S&P, which could mean a move toward a broader market health. But at the same time, we want this index to be doing well.
Well, and we were looking, and we didn't put this slide in the presentation, but there was a number of analysis that a number of research firms did on last year and even the first part of the year. And it was basically of the S&P 500 components, 495 of them were basically flat for the year.
That's right.
5 were positive. So
The big ones.
the Magnificent Five, we're not sure it's the Fab Four, the Magnificent Seven now, but 5 or 6 companies carried the entire index. And if you were invested in individual stocks or maybe small cap things, that might have shown itself in small caps here.
Yeah, so here's the Russell 2000 small cap index. Kind of a painful month here, Mark, minus 6.85% close to close. And this swung almost 10% from peak to trough. So the difference is the trend is clearly down here. Investors did seem more skeptical of small caps in April. That's different than we saw in March. And this very large swing, just it might mean that investors are skeptical.
Yeah, there's a lot of signs that are pointing to conflicting signals, if you will, in the market. We'll talk more about that large cap, small cap relationship in just a moment.
So here's the real shocker, Mark. Lastly, of course, we'll look at the long-term Treasury index, minus 6.76%, and that swing as much as 8%. We saw several gaps down, really showing how volatile this index can be. It's actually over 10% down at the end of the month as far as a year-to-date figure.
Year-to-date figured minus 10.8%. And that's, and unfortunately, a lot of people have a large portion of their portfolio in a bond allocation. This is supposed to be the safe place when the market's supposed to is acting a little bit squirrely for us. So this is a systemic, a dynamic change to the way we invest client money. And I'm afraid that a lot of the industry hasn't picked up on this, that the old 60-40 portfolio just is not working the same way it has over the last 40 years. Basically what happened, Jesse, is that yields rose through the month, which pushed the value of the bond down.
That's right.
Interest rates rising, yields rising. And that's not good for a good outlook for the long-term Treasury index. And of course, we'll take a moment here to put our disclosures on the screen. We always like to be
these in great detail,
compliant, and take a picture of this if you want to. So if you're ever asked by a regulator, you'll know that you did in fact read that these are just indexes, and you don't necessarily invest in those indexes. They're just snapshots of the overall components of different markets and things. So, all right, let's jump in. Let's look at that comparison. We've talked about this many times, Jesse.
Yeah, so we've been adding to this chart every month since really the middle of last year when they started splitting. But here's the large caps compared to the small caps, the large S&P index being green and red, and the Russell 2000s in blue. And you can see in March of last year, they began to diverge. And that's not what we want to see.
No, because we usually, when we're coming out of a bear market, we typically, in previous bear markets, we see the small caps lead the way. And they have actually been underperforming large caps over the last really now year and a couple of months.
That's right. And in March, we had just a few points in the right direction where small caps outperformed. But of course, we're back to the trend here where these indexes continue to diverge in April.
We'd rather see these indexes come together, but they're actually widening.
Right.
And that's critical for the overall health of the stock market. But it doesn't mean that's a gloom and doom situation. It just means it's something that we will continue to watch. And you can see really in the last few months, the small cap indexes is beginning to really flatten out, even though there's been a lot of volatility.
Right.
We had hoped that had been closing the gap, but apparently that hasn't happened. And so we'll continue to watch this even further.
So here are a couple quick comparison charts. The first one is large cap versus small cap. When this black line is moving up in a trend up, that means large caps are winning or outperforming. And we can kind of see that they've been fighting back and forth all year long. The last little piece there is April. And you can see the first 2 weeks, the large caps were winning, and then they started losing. So they really can't make up their mind.
Yeah, and that's a dynamic we look at just to be able to compare, see, hey, what sectors or asset class sizes are performing better than others. And right
Yes.
now there's still, it's still mixed and it's not clear.
So here's a similar chart that I thought I'd throw in, not to confuse anybody, but this is growth stocks versus value stocks. And it's the same trend where when the black line is going up, growth stocks are outperforming. And notice in April, we saw almost this wrestling match where it went back and forth and it dipped quickly, where we saw a quick increase in the value stocks and then it changed back. So once again, this is not a clear winner here. We don't have one style that is winning over another.
And remember, folks, you can send your messages to 254-282-0495. That's our text line. You can send us a text there and ask your questions at any time.
Yes.
All right, let's keep moving on. If I can find my cursor to be able to move us on.
So, Mark, you want to explain what a 200-day moving average is?
Yeah, that's it's a longer term trend indicator, and it is seen as a sign of strength and is bullish. If the amount of stocks are trading above a certain percentage, above their 200-day moving average, we see that as bullish. And we only go back to the beginning of the year, but you can kind of see that the general trend has been sideways and down a little bit in the month of April.
We want this to be at 60 or higher
yes.
to be really bullish,
And
and
we
maybe
just,
even 70.
Yeah, and we just touched that a little bit in the month of March. This was back at the end of October of last year. This was in the low 20s.
Yes, and it changed very quickly.
Yes, and moved up, and we saw lots of changes and a lot of positive momentum in the market. Right now, we're still in that sideways motion. At the end of the month, this was hovering around 50%.
We did have a new low for the year, though, at 47.
Oh, yeah, and when it's this way, it just means that there's not a lot of momentum in the overall market.
Right.
Okay. We'd like to see it stay above 60, though.
So I showed this slide last month, but I just thought it was so valuable. Everyone wants to talk about the Magnificent Seven, and here's really how those 7 companies, I can't tell you which ones they are, but how they've performed compared to each other, and really why we're ruling out 2 as not relevant anymore. And I bet you can guess which ones those are, but we won't say. And then there's really 4 now that are leading the way. And
the Fab Four.
The Fab Four, right. So we'll see what happens moving forward if these huge companies can continue to outperform.
Yeah, and in earnings, we're right in the middle of earnings seasons. About 2/3 of all the components on the S&P 500, those companies have reported earnings, and it's been mixed.
Yes.
Some companies have blown it out of the water. Some have been kind of subpar and underwhelmed, if you will.
That's right. You're probably watching this on a device made by one of these companies.
Perhaps. Okay, let's keep going. We've talked about this before, but it's just kind of the analysis that bull markets or bear markets take time to recover. We are still seeing long-term treasuries a long ways from recovering.
These are updated year-to-date figures as of the close in April. So if you're curious what your portfolio might be compared to, we have the NASDAQ and the S&P, which we talked about already. Of course, the long-term treasury we said is down over 10, over 43% since the peak, Mark.
Yes.
That's now. That's the price now. And then we follow a moderate portfolio index that actually crossed into the negative.
It did. Yeah, and the that moderate portfolio index is something that if you're in your 401k and you're near retirement, there's a good chance, just based on our experience and what people are putting into their portfolio in the 401k, there's a good chance that you are in that moderate portfolio.
Right.
It's that mix of bonds and stocks. Everyone's going to be a little bit different, but if you're on the autopilot default investment option on your 401k plan menu, it's a good chance that you are in some type of moderate portfolio.
That's right.
And moderate hadn't been doing too moderate or too hot in the last couple of years. In fact, that index is still off of its previous high back in November of 2021. So almost, Jesse, 3 years that portfolio has been struggling.
Right.
Okay.
So we'll shift here and talk about the macroeconomic outlook. But as a reminder, please send us a text. We'd love to hear your questions. 254-282-0495.
All right, I'm getting ahead of myself. I'm pushing the button too fast.
So here you go, Mark. Here's some Fred data.
Some data from the Fed, the Bureau of Economic Analysis, and so forth. You know, we're looking at this. The United States has really had the best performing stock market in the world for the past 4 decades, right? Better than international.
Right.
We were talking about this in a study session a few weeks ago about how the United States really is the only country that adopted that 60-40 portfolio of holding a mix of bonds. Many other countries, they may use more real estate than bonds and things. But nonetheless, the United States had the best performing stock market for the last 4 decades. And that same portfolio concept tried in other countries have had weaker results. And the ones in developing countries, they tend to focus more on real estate than equities for this reason. Now, your interest rates are really still, they're no longer structurally declining. Okay. That's going to create a problem. And this is that shift that I talked about earlier in our presentation today. There has been a structural change in the way markets are behaving. If you haven't talked to your advisor about how you are adapting to that change, you need to do that now. We've been adapting to this for several years because we saw it coming. And especially after the pandemic and the amount of government spending that's going on, interest rates starting to rise rapidly and starting in 2021, you know, a lot of things are shifting and changing, and it will be a long while before that shift changes. Because we're going back 40 years, Jesse.
That's right. If you drew a line here from the peak in 1980 and then you connected it all the way down to 2020 when we hit zero, you can see how aggressively down that line goes.
That's right. And when there's a little concept called modern portfolio theory. It was developed by Harry Markowitz. If you're a client, you've heard me talk about it. It was based on his 1952 PhD thesis. Bright guy, won the Nobel Prize and everything. But he has even said that he would not manage his portfolio that way. He was just trying to demonstrate relationships and trends. His thesis basically said if you hold a diversified basket of stocks and bonds over time, you will outperform other scenarios. What a lot of people forget is that time frame was more than 150 to 200 years.
Yeah.
Most of us don't have a 200-year investment horizon. And what happened in the 1970s was the financial industry said, hey, this would be a great way for us to sell stuff. And it's easy. And if we all get together and do the same thing, then nobody can complain when the market goes south. I'm overgeneralizing here. But even Markowitz himself said that he never intended that to happen. But the environment that was going on then was that you had basically a stagnant stock market for the last 10 to 15 years in the late 60s and throughout the 70s. You had rising inflation, and to a great extent, not as bad, even more so than we have today. And you saw the cutting of those rates to stimulate the economy over time. That was the ideal scenario for that time. We believe that scenario doesn't exist anymore. We have gone through, as Jesse said, a 40-year decline in the rates or yields on bonds, and that has caused the value of those bonds to buoy up, increasing your portfolio. But back in 1982, you could live off the interest from your bonds.
Yeah, because the rates were so high. You can see 12 to 15% Fed funds rate.
I remember my parents talking about having a 15% CD.
Wow.
But their mortgage was 17%. So there's a trade-off. And this is something this is a structural change, and we want people to pay attention to that structural change. Here's a little bit of a chart with the change of oil price and the official consumer price index. Goes back over a century. it shows the cumulative percent changes over 5-year rolling periods and to filter out some, the short-term noise because oil is volatile, right?
Mm-hmm.
The other direction is not quite as consistent since there was only one exception, the 2000s, where we had a decade of high oil prices and not so high inflation. Because that was the peak period of growth in China, which brought about a big disinflationary wave of low-cost manufacturing to the world and offset a lot of energy-driven inflation. But this is something that we're looking at because we're seeing that change as well. This is a different scenario than we've had in past decades. All right, so this is inflation-adjusted S&P 500. This is just showing you periods where large cap equity growth indices did poorly during the 4 periods that we've got circled there, the 1910s, the 1940s, 1970s, as I mentioned earlier, and the 2000s. Now, we all know what happened between 2000 and 2013 is basically the lost decade, right? You had some indexes like the S&P that did not recover until 2010 from the 2000 and 2002 bear markets. You had the NASDAQ, it was more than 2013 before that index recovered. We've talked about these things before, but this is always a case in the inflation adjusted terms, and it's usually the case in nominal terms as well. A 60-40 portfolio historically offers little protection against these waves of inflation driven by those energy and commodity capex cycles and related issues. It's purely geared towards the expectation of structural disinflation. Let's make that point again. The reason that the 60-40 portfolio has worked in the 80s, 90s, and so forth is because it is built based on the expectation of structural disinflation. Are we having disinflation right now, Jesse?
Absolutely not.
Absolutely not. And so you're not seeing that movement in a 60-40 portfolio that you would have thought, and many people are disappointed with that. You can give us a call and talk to us about your 401k and things, and we can try to help you understand what's going on. And maybe there are some things and adjustments that you could make if you're not satisfied with that.
So one last Fred picture here, Mark.
Yeah, lots of folks benchmark bonds against official measures like price inflation. But there's other measures that are better because as an investor, you don't want just to keep up with the prices. You want to keep ahead of your share of the total economic output and asset prices. So if we compare bond yields to gross domestic product, for example, there are structural periods where GDP, gross domestic product growth, is completely outpacing bond yields.
So you're losing to the actual growth of the economy.
Right, if you're owning bonds. But the yellow areas in this chart, which we're in one now, okay? So, and historically during those periods, it's a better way to almost anything else other than bonds. So conversely, there are periods where bond yields are nearly as high or even higher than GDP growth. And so owning bonds is actually a good trade during that time. And you can see that from 1980 to the early 2000s.
It's the places without yellow in them.
That's right. And so there are periods of which you want to own bonds, and there are periods where you may not want to own bonds. Now, we're not making recommendations for you to go and change your portfolio. Let's make sure we talk about that. I just want to make sure that people realize there has been a structural change in our market dynamics, both in the stock market and the bond market, that people need to pay attention to.
That's right.
Okay, sorry, I didn't mean to harp on that, but I'm big about people recognizing that change, and a lot of financial advisors have yet to recognize that shift.
So we'll get into it in just a minute, but the jobs and labor statistics are extremely important when it comes to the Fed making decisions. So a new report from the Federal Bureau of Labor of Statistics this week, the U.S. economy added 303,000 jobs in the month of March, and unemployment fell slightly to 3.8.
And we'll be getting April jobs data actually tomorrow. So we'll be able to update this.
Some people were calling it a blowout jobs report, though.
Yeah, and it's not quite a blowout jobs report. What we're seeing is we're seeing a lot of vanishing of full-time jobs. The way that the Bureau of Labor Statistics reports job growth or job vacancies, and the JOLTS data came out yesterday, which is the job openings, It's stabilized. It's not rising anymore. But when you hear the jobs report, and tomorrow morning if you listen to the news, they'll say, hey, the economy added, and I don't even know what the predictions are. Last time they were way off.
X 100,000
Yes,
jobs.
X 100,000 new jobs in the last 30 days. That establishment report really counts every job, Jesse. And let's go ahead and just
all types of jobs.
All types of jobs. Mainly, think about part-time jobs.
Yeah. So here, this shows a distinct shift in full-time versus part-time jobs. In fact, the analysts that we've been following at this Mises Institute is calling it a recession in full-time jobs. Right?
If you look on this chart, the black bar are part-time jobs, and we've seen tremendous growth in that in the last several months. The yellow are full-time jobs, month-over-month change. And we have seen a negative decline in month-over-month change of full-time jobs for the past 3 months. Now, tomorrow we'll get the new data for April. If it's another month, that is adding some good information to the Fed's quest to find that the economy is slowing a little bit. They're balancing, having this balancing act of trying to figure out which way the economy is going to go. They don't want to, stall the economy, but at the same time, they've got to keep their hands on inflation. So, and this is real important because you're going to see lots of different information. You got different sources of data that are trying to paint their own story. Let's just talk about Washington. What is the big thing that people want to know about Washington when it's an election year? How's the economy doing? And the message is the economy is doing great. And part of it is that we've added $3 trillion to our federal debt just in this fiscal year alone. The government is propping up the economy. There are some good things, but what this chart shows is that more and more people are working more than one job.
That's just not sustainable. We all know that part-time jobs are for shorter time periods and they pay less.
Exactly. So other trends that we noticed this month, Jesse, is that we had defensive sectors. This is something like utility. What's a few others, Jesse? I'm sorry, I'm drawing a blank right now.
Some consumer
products and things like that are more the utilities.
Staples that you need, like toilet paper.
Yeah, those are defensive. We've seen bond yields rise, as we mentioned. There's a lot of indications that the S&P 500 might be a little overextended, but
this
it'll pull
back. Did help.
Yes, and that's kind of the pause that refreshes.
Yeah,
is the way we're choosing to look at that. A lot of people think that as the economy goes, so goes the stock market. They are two independent beasts, if you will. We saw pullbacks all across the indexes. What we said is the pause that refreshes. Inflation is steady on the overall CPI, but we're going to talk about the core CPI in just a moment. That is still remaining a problem. Okay. Now, department store sales are dropping off a little bit, Jesse.
This is a very long-term chart. I just realized how far out this goes.
Yes. And you've seen that, but there's this fandangled thing that back in the mid-90s that was called the interweb. The interweb, and we could send messages to our friends at different places. But e-commerce sales have continued to rise. It is cyclical. This is the red lines are not seasonally adjusted, yet the blue line's a little bit more level, and that's continuing to rise.
So we're changing the way we're buying things.
Yeah, absolutely. And right now we're still spending. Consumer spending is still continuing to be done, okay? Now, this is consumer confidence. So this comes out every month. That has been rising over the last couple of years after we came out of COVID. But that is ticking down just a little bit this last quarter. But that's something we just watch. That's just, what's our confidence that we can spend money because we think we're going to be able to keep our job and so forth.
I mean, look how much lower it is from pre-pandemic.
Oh, yeah. I mean, we still got a long ways to go. People are still cautious about those things. And so to see it, I looked at each instance of consumer sentiment. Okay, I looked at all this stuff and the current levels. This situation has only happened 10 other times in nearly half a century. And when it's dipped like this, it always led to continued stock gains. So stocks in general have led the fantastic returns since the data began back in 1978, and that was near the generational bottom of the early 1980s. The S&P 500 has returned on average 9.2% a year since then. But you can crush that turn if you buy when consumer sentiment is on the rise. So there's a little bit of a tick back this month. We're going to look at it going forward, but it usually as consumer confidence and consumer sentiment, increases, stocks follow along with that. Okay, and that's why we're seeing this as a pause that refreshes, not a shift in the way that the overall indexes are behaving. Okay.
Yep. So here's something that we're all feeling. I put the piggy bank on there because we're all interested in what the interest rate environment is doing. But the Fed met yesterday.
Yep, it was Fed day.
We sat there in the office and watched his speech and analyzed every word, and they didn't do anything.
Yeah, and that was the big news. They didn't do anything. But one of the terms that Chairman Powell said that the market ticked up on was that he thinks that the things that they have done already are sufficiently restrictive, which means they are leaning towards not raising rates.
Yeah, he refused to talk about future rate hikes, which is probably why the markets reacted positively.
At least for 45 minutes.
Yeah.
And then they gave back everything that they earned during that time. But he said basically that, in more words or less, that a cut was basically more likely than a hike. But remember, we started the year, it came out in December, and we were expecting 6 rate cuts this year.
Yep.
Most analysts are saying that maybe one.
Maybe one, likely 0. Don't be surprised if there's 0.
Yes, and that might come in December. But this is a political year, even though Chairman Powell was asked, hey, are you put under any pressure to do this? And of course, he politely told her no. But we all know that Washington is a place of, I don't want to call it incest or anything, but it's a place where there's a lot of deals that are done. And it has happened in the past. Previous Federal Reserve boards have responded to political pressure. And potentially we might see that again. I don't know. I think this chair and this board is cautious about igniting inflation again.
Yeah. Jay Powell yesterday talked about how much, quote, diversity in thought there is within the Fed. And there really are some disagreements within what people think.
Yeah, exactly. Well, here's the yield curve. It still remains negative and inverted. That started in March of 22. That means we've been in over 26 months of the inverted yield curve. So more than 2 years.
And we're feeling it.
Yeah, we are. And this has proven well for short-term treasuries, not so much for long-term. But just as a reminder, and we can say this time might be different. The inverted yield curve is proven historically to be a precursor to recession.
Every time.
Every time that has happened, at least to the times we've actually collected data. But you see the 1-month yield still around 5.5%. The 30 yield is around 4.3. But please note that this is all these rates are dramatically higher than they were in 2021. Okay.
So we're going to get wrapped up here in just a minute, but I thought I will include a few slides from a really good presentation that we watched from our friends over at Eventide. But this just shows the rate hike cycle and how quickly we raised them. Notice that flat line really for most of 2023 and going through this year. They have kept those rates high. I thought it was a good visualization of where we're at.
Yeah, and notice that the rates climbed up very quickly, but they've left them high. And a lot of analysts think that we're going to see higher for longer.
We got really used to that flat line 0 in 2021.
Oh, it was very nice. I'm glad I refinanced my mortgage during that time. Okay.
Here's the 10-year yield on government bonds. We mentioned it earlier. It's very closely related to borrowing costs for you and I on everything we borrow. But look where it's gone in the last 5 months.
Yeah, I mean, it did drop dramatically from October, but then it has regained some of that in the last 5 months. So we're going to continue to watch that. That means you'll see the 30-year Treasury go up. You'll see 30-year mortgages go up. Lots of different things there related to that. It's cost of borrowings where this goes into. All right, here's where, and this is the last economic wonky talk we'll talk about. And that is the difference between consumer price index and the core CPI.
So we're throwing out the super volatile things.
Correct,
Like
on the core CPI, but it still remains stubbornly high. And that is the main measure that the Fed is watching. Remember, their mandate is to try to keep inflation around 2%. They have not been able to make any progress really since June of last year.
Yep.
And that core CPI components continue to be really sticky, and they're somewhere just barely south of 4%. We'll get April inflation data coming up in about a couple of weeks. Remember, employment data will come out tomorrow. So don't be surprised about what happens with the job market. We don't try to predict. We just try to respond when data doesn't prove to be profitable or possible for continued growth in your portfolio.
So I threw in this picture as a nod to our friends in the medical community. We work with a lot of people there, but how does this impact you? Obviously, your retirement savings are directly impacted by the things we're talking about. Whether you understand the nuances of the CPI or not, your savings are working.
Right, and this is carried over from last month. Inflation's still rising. We saw that go up a little bit. It's growing at a slower pace than it was a year ago, but we can't forget that it's still going up. That means it's still costing more for things that you buy every day. And we've shown that market signals are mixed. There was a little bit of a pause in April. We think that trend will continue on the bullish side in the future, but we will have to watch and see. But we still need to see that improved breadth of the performance in the market. We're still struggling with the bond market. That has not improved at all, and it will not improve until interest rates start falling, which may be well into 2025.
It could be. Of course, on the personal side, credit card debt is still extremely high, higher than in spending years. Money supply is low, and we haven't even mentioned the big looming election.
Right, and I'll just say this: we're gonna have our next month. We'll have a program in June, and we're just going to talk about the history of elections and what it does to markets. Because I want to dispel any myths that you hear out there. Because there's an old adage in news, and the adage is, if it bleeds, it leads. And if you've ever listened to a news program or a business program, they don't start the day with a feel-good. They don't start the show with a feel-good story about someone helping their fellow member of their community or their church. They talk about something bad. Somebody got shot. Oh, they're rioting in college campuses around the globe. Oh, this is bad. That's bad. This is an election year. And my gosh, we can't have that person elected. And we certainly can't have that person elected. It's all designed to make you worry so that you will watch their program or read their paper or whatever.
So do we have a solution to that?
Yes, don't pay attention to it. Okay. That's the biggest thing that I found people that will give them more peace, is just simply shut out the noise. And this is a season, it happens every 4 years. We get a lot of noise. And regardless of what happens at the ballot box, our country is strong, and we will continue to function. There may be different types of worries that we might want to talk about on a different program, but we need not worry about elections. Election season brings anxiety, I know, but it's a situation that doesn't dramatically impact the market.
That's right. So all we're saying is you need to have a strategy in place to navigate this world that we're living in. Make sure that you and your advisor have that strategy. If you don't have an advisor, we'd love to talk to you. And like Mark said, don't panic. Don't make decisions based on these headlines that lead and bleed.
I will say this: it's going to take a long time for the markets to settle down to a point where they behave in what we consider a normal fashion. So there will be volatility, but the future is bright. Things are improving. especially over 2022. And so we encourage you to just touch base with your advisor, look at your portfolios, still keep investing. Don't start taking money out and hiding it in your mattress. Okay.
It feels so natural to freak out on a headline and
Well,
drastic decision.
Yeah, and most people don't, Jesse. It's just that it begins to wear on you, and you think, okay, am I doing the right thing? And should I be doing something different? Stay the course. Make sure that you're maximizing, if you're holding cash, you're maximizing getting the best yield you can on that cash and your savings, whether through CDs or different types of things. We love to talk to you about that. If you have questions about how best to use cash in this market, and we also, this is something that people overlook because they just put their head down. They have a contribution go into their 401k at work and they don't look at it. Be careful about following the advice, and I'm using my quotations here, of your 401k plan provider. They are not giving you advice. They're giving you that typical stock bond portfolio that we've been talking about that's changing over the last couple of years. That is not the way to go. And I still not have seen 401k guidance wake up and make adjustments. They're still giving you the same advice they gave the people in 1980, and it has to change. We can help you. If you want to take a look at us to take a look at your portfolio, that's complimentary. We don't do that. We don't charge that just to take a look, maybe give you peace of mind. And but don't sit idly by. I've heard so many people talk about, oh, my employer's looking out for my 401k. No, that the employer is offering the ability to make payroll deductions into your 401k, but they're not looking out for you necessarily. They have to do a regulatory review to make sure the investments are behaving the way they're supposed to. But when they're in a down market, they're supposed to fall down and drop. When the bond market is still bearish, you're going to expect them to drop. That doesn't mean that Mrs. Jones, that your employers talk to Mrs. Jones to say, okay, you're thinking about retirement here in a few years. Maybe we need to diversify that a little bit. Maybe we need to get more conservative. Here's how to do that. That is what you call looking out for you, and your employer just doesn't do that. I'm sorry, I hate to burst the bubble of folks that think that their employer is looking out for them in their retirement.
Yeah.
They've offered you a vehicle to save for retirement. It is not necessarily the best way to take care of that money. Okay.
Yeah.
All right. Sorry, I didn't mean to harp on that, but
that's all right. We'll wrap it up here. Same strategy here. Check your statements, talk to a professional, preferably a fiduciary. We would love to talk to you and just educate yourself on what's going on.
Yeah. Any questions, Jesse, on the board? I didn't see any right now. People always text us and email us later on.
Yeah, we're happy to answer those at any time.
If you think of something here in 10 minutes, feel free to reach out to us. But thank you, folks, for listening to our webinar today. I know it was a little bit longer than normal, but we appreciate your attentiveness. As always, please give us a call if you have questions about your portfolio or it's time for a review. We'd be happy to visit with you. Thanks and have a great day.